Hi, I'm Pattu from freefincal. Let's talk about Aditya Birla Nifty 50 Equal Weight Index Fund. In this video, this is an NFO. The NFO period is currently ongoing. I have several times talked about the equal weight indices. There are two equal weight indices, the Nifty 100 and the Nifty 50. We already have DSP 50 equal weight, Nifty 50 equal weight index, and then there are two Nifty equal weight indices for the Nifty 100. One is Sundaram, one is Principal, but I think Sundaram is buying Principal if I'm not wrong, so there will be just one from now. So the main difference between the capitalization weighted index and the equal weighted index is what you see in this. This is a picture from the NSE. So in a market cap weighted index like the Nifty, the Sensex, the Nifty 100, etc., the top few stocks, for example, if you look at this, the weight of the index is increasing here. By the 11th or 12th stock, 60% of the weight is covered. There are 50 stocks in the Nifty, but 11 to 12 stocks alone cover about 55-60% of the weight, and the rest of it is a much smaller weight. Whereas in the equal weight index, all of them will have the same weight, and for example, it will be 2% in the Nifty 50 and about 1% in the Nifty 100. And the advantage of the Nifty 50 equal weight index is that when there is a broad market rally, when all the stocks, all the segments of the stock market are moving up, then there is a chance that the Nifty equal weight will beat the market capitalization weighted index. But this can be very frustrating, as many people who have been tracking this index would tell you. Today, if you look at the Nifty 50 equal weight, it has got the highest 1 year trailing return in the large cap category. But if you look at the past, if you look 1 year earlier and so on, you would have been shocked to look at the poor performance of the Nifty 50 equal weight. Now the NSE claims that the equal weight index benefits from better diversification due to lower stock concentration risk as compared to the parent index, which is Nifty. One of the major benefits of equal weight strategy is better diversification by avoiding concentration of portfolio in a few big stocks. Well, this is true, but this is more a theoretical benefit. Does it actually give you consistent benefit is what we have to see, and the answer is no. And they also go on to say that equal weight index strategy tends to have a higher stock weight turnover and higher liquidity constraints during portfolio rebalancing, which is quarterly, making replication relatively more cumbersome. So that is something that we can see from the tracking error. I have a tracking error sheet which is monthly published. You can check that from there, that the tracking error of Nifty equal weight indices, even Nifty 100 will be higher than that of Sensex and Nifty. Nifty next 50 tracking error will be higher than that of Nifty 50. Nifty 500 will be much higher than that of the Nifty. This is the problem generally in India, because only a few stocks have got very high impact, very low impact cost, that is, you can trade a lot of these stocks in large volumes without changing the price. But the impact cost as well as the poor impact cost as well as the equal weight can cause problems for a index fund. And if you look at the since inception evolution of the Nifty 50 equal weight index, which is the red line, compared to the black line, which is Nifty 50, this looks impressive. But viewers must understand that this is a point to point. From this point to that point, we are comparing return. So in this graph, although it looks nice and shiny, you are actually seeing only one return data point of the Nifty 50 equal weight compared to that of the Nifty 50. You have to do rolling returns. You have to look at every possible 5-year, 10-year, 15-year window between June 1999 to May 2021. So if you look at the 5-year window, the pink line is the Nifty Next 50, the brown line is the Nifty 50, which is more or less invisible in this graph, which is almost sitting on top of the yellow line, which is the Nifty 50 equal weight. You can see that the Nifty Next 50 has outperformed in some parts, but over 5-year period you cannot distinguish too much between the 50 and the Nifty and the Nifty and the Nifty 50 equal weight. then you can see over 10 years the pink line has pulled apart well. There are some periods where the yellow line is just above the brown line. The yellow line is the equal weight index, brown is Nifty 50. But there are other areas, for example, particularly in the last few years, the yellow line has been below the Nifty 50. So it has been a frustrating period for investors holding equal weight indices. And if you look at the 10-year data, sorry, the 15-year data, since somewhere between in early 2019 onwards, or even mid 2018 onwards, the equal weight indices has not bet the Nifty 50 over 15 years. So it's a very frustrating index to hold. It's a high risk, possibly high reward guaranteed high risk, possibly high reward strategy, as I always say. So my suggestion is, please avoid this. You just need a combination of Nifty 50 and Nifty Next 50. Don't get excited over every index fund NFO or every NFO that comes. Bye bye.